You're paying 9% more in taxes on your investments than you need to. That is $22.50 for every $250 in gain. And that scales up fast. Here's the account nobody talks about. The last 3 weeks, we talked about 401ks, IRAs, and HSAs. All of those are retirement accounts. But not everybody wants to get rich by 60. I get it. In the next few minutes, you'll learn the non-retirement option that allows you to withdraw at any time for any reason. No penalty. And here's the twist. Traders are getting absolutely ravaged because they don't know what I'm about to share with you. Plus, there's a Fidelity study that proves doing nothing beats trading. Doing less equals more. Enter the taxable brokerage account. This account should be used in a big way. You invest in this account after taxes, meaning that you get your paycheck, you get taxed, and then you take your after-tax money and you can invest it in this account. This is perfect for goals greater than 5 years, maybe a down payment on a house in 7 years, but anything less than 5 years, use a high-yield savings account because of the stock market volatility. Based on actual data, you do not want to invest your money for anything less than 5 years. But here's what nobody talks about. Taxes within this account are entirely different, and they're not as bad as people make them out to be. Now, this next part is crucial. Your taxes depend on 4 factors. Number 1, tax types: capital appreciation, dividends, and interest. There's also potentially net investment income tax, but we're going to skip that for this video today because that's for the extremely wealthy people. And what we're doing in this video is learning how to become wealthy. Number 2, tax filing status: single, married filing jointly, married filing separately, and head of household. 3, the amount, the size of the gain, not the total balance. Number 4, time held: less than a year or greater than a year. But don't click away because I'm going to put the capital gains tax rate table on the screen. Make sure you screenshot this. Here's what gets crazy. The first tax type is capital appreciation. So let's assume you buy a stock for $100, it increases in value to $110, and you sell that stock. That gain is $10. It's not the $110 that you sold and received. But you need to understand how the taxes work depending on the tax type you receive. So for capital appreciation in the example I just shared, anything short-term less than 365 days is taxed unfavorably at your ordinary income tax rate. Now, your ordinary income tax rate is dependent on how much money you make per year, you and your spouse as a collective couple, and in line with the tax rate table for the applicable year. Anything long-term greater than 365 days, you're taxed at the capital gains tax rate. Typically it's 15%, but it could be 0, 15%, or 20%. And that's how you're taxed on capital gains. But there are also dividends. Dividends could be qualified or unqualified. If a dividend is qualified, which most dividends you're thinking of are qualified, you're taxed at the capital gains tax rate table, which is 0, 15%, or 20%, typically 15%. However, if they're unqualified, they would be taxed at your ordinary income tax rate. And again, that's dependent on where your income tax rate falls for the particular year. So most dividends are qualified, but some are not. One of the most popular investments held by the everyday person is a REIT, and the REITs are considered unqualified. And that's a huge tip I just gave you. Meaning, if you hold a REIT, real estate investment trust, a lot of individuals hold this type of investment. However, they hold it in their brokerage account, which is killing them from a tax perspective. Assuming that's the case, you are getting taxed at 24% or your ordinary income tax rate. It's an unqualified dividend. Whereas on the reverse side, if you took that same investment, that REIT, and put that in a retirement account like an IRA, you would be taxed at 0%. That is a 24% tax savings. Yes, you just heard that right. And yes, this is why you work with CPAs. And no, this is exactly why you don't listen to gurus online with Robinhood accounts. I always like to poke fun at Robinhood. The next tax type is interest earned. Oftentimes, this is a fixed income payment like a bond. These are always taxed at ordinary income rates or unfavorably. And so therefore, you want to hold these traditionally in a retirement account as well. And again, if you're in the 24% tax bracket and you have a 15% potential tax on capital gains, understanding these tax types are critical. Because for example, how long you hold this and the type of dividend you receive, qualified or unqualified, could result in a 9% tax difference. And having bonds could cost you up to 24% in this example. That is substantial. Let's look at a real life example. So John Doe has $100,000 in income. He's a single filer and he has $500 extra per month. So on January 1st of 2023, John invests the extra $500. 80% goes into VTI and 20% goes into VXUS. And his account grows to $750. That's a $250 capital gain from $500 to $750. So scenario 1, let's say he sells June 17th of 2023, the same year, less than 365 days. Given he would be in the 24% tax bracket in that given year, You would take the $250 gain and multiply it by 24%, and that would equal a $60 tax hit. So he would keep in this scenario $690. Scenario 2, he sells February 12th, 2024, greater than a year. You take the same $250 gain, you multiply that by his capital gains tax rate, which is 15%, and that equals $37.50 tax hit. He keeps $712.50. Same gain, different timing, $22.50 difference. But wait, check what happens when you scale this. You might be thinking $22.50, that's not that big of a deal, but add one zero, add another zero, add another zero, and we're talking thousands of dollars of difference. The high net worth individuals I talk to understand this game to a T, because it's not just the tax savings, it's what you do with the tax savings that will then compound into future investments, and the difference is substantial. We're talking 6 to 7 figure differences because you understand taxes. Here's what traders do not understand. Like we talked earlier, putting a REIT or bond in a taxable brokerage, in the example we used based on the ordinary income tax rate, you'd pay 24%. But you put that same investment into a Roth IRA, you pay 0%. ETFs and index funds, they're generally tax efficient anywhere. But if you don't know this game, you're losing hundreds of thousands of dollars to the tax man because you're too cheap to pay for advice. Remember those traders getting ravaged by taxes? They hold things less than a year, paying 24% instead of 15%. They're probably dealing with REITs in a taxable brokerage account. They have no idea what they're doing. Almost every trader I talk to has no idea what the tax code even says. Meanwhile, there's an actual Fidelity study that say dead people and inactive people are their best investors. Why? Because they bought, they held, and they didn't make moves that incurred taxes and fees. Listen, here's what Uncle Sam is telling you. Hold your investments, buy low-cost index funds or ETFs that are tax-efficient vehicles, and just don't do anything. It's as simple as that. Every single year, you don't understand this, the tax man is drilling you. This taxable brokerage account is awesome, but do remember, taxes in this account are completely different from the HSA, IRA, and 401k. And I have all 4 account types, actually a solo 401k since I'm not W-2, but it operates very similar. We have 2 IRAs, 1 HSA, a solo 401k, and multiple brokerage accounts for different goals. This is how most people should set up their investment. Your next step, go check if you're holding any investments for less than a year. You can check by checking the tax lots. Number 2, check if you have any REITs or bonds in a taxable brokerage account, and work with a professional if you do not understand the tax game. It will cost you more money to guess than just to pay your tax professional. So with that being said, drop your biggest takeaway in the comments below and screenshot the tax table while still on the screen. So these 4 accounts should be at the top of your list: 401k, IRA, HSA, and taxable brokerage. But I hope you enjoyed the last 4 weeks of specific details with specific accounts. And as I mentioned before, the priority of investment account video is in the show notes below so that you understand how to use all of these accounts in conjunction with each other. I will see you next Monday.